Good evening, everyone. This is Henry Gambell with simpleroptions.com, and in tonight's free video I wanted to discuss some ideas that we had used when trading Oracle. So Oracle had earnings that were due out after the close today, and they've already reported, but the idea heading into this is that I like the idea of this overhead level here, basically around 48, holding as resistance. That would push it to a new high, that would make some extensions, and I thought, that was right there in line with the expected move, so that looks like a good target. The only problem with that is you did have a daily squeeze, which will sometimes suggest a bigger than expected move. So the way that we stack the trade, two ways to show this. I like looking at it here in the actual position table so you can see exactly what we have, and then flipping over into the risk profile to kind of help it click in two different ways for the exposure that you have. But the whole concept on doing something like this is saying, okay, the $2 wide butterfly is going for 50 cents. I usually try to buy those in the lower 1/3 of their range, which would imply 66 cents. So by paying 50 cents for it, I'm getting a little bit better than what I typically would, and that made for a good risk reward on the butterfly. You can see you take 10 of those. Then for the put credit spread, was kind of the thinking that if it did have a bigger than expected move, at least the credit for this will help offset that. So where this would have been a perfect offset for the risk is if I would have taken in a $1 credit on this spread. Instead I took in 92 cents, did 5 of them, so it almost completely compensates for the debit that I have to pay on the other side. And then to make that all come full circle, when you look at your risk profile graph, it's just saying that if we did land up there around the 48, that's where I would max out my profit. If instead this does open up and just keep ripping higher tomorrow, I still have little to no risk to the upside. And then of course in a perfect world what will happen is this gaps somewhere into this area. We can cover the put credit spread somewhere near a nickel, and then if this can drift back around 48 towards the end of the day on Friday, we can make money on both sides. But at worst it becomes a scratch, and I think that's a good way to look at staggering various spreads around earnings. So I hope that's helpful. If there's anything else I can do to help you, please let me know, and otherwise I will see you guys at the next free video.